Hello, and welcome to Introduction to Investing. I made this PowerPoint presentation because I've been getting a lot of comments from some of my viewers that they're new to the field of investing. So I thought I'd put together a PowerPoint presentation and just give you a quick overview of what you can expect to see in this field, and just to kind of get you acclimated with some of the terms and products. So, first slide, what can you invest in? Well, you can invest in either equity, which are your stocks, or you can invest in your fixed income products, which can include your bonds, money market, and structured debt products. So with your equity and stocks, you have two options really. You can buy a growth company, or you can buy a value company or do a value play. What a growth company is a company that has high earnings growth expectations going forward. Most of your technology companies are growth companies, and what that means is that they already have priced into their share price right now high expected growth rates going forward. So if you believe that the company is going to grow even faster than those high expected growth rates, you would want to pick them up. If you believe that they're going to grow lower than those expected growth rates, you might want to wait and hold off on buying them. Now a value play is when you're trying to get a company that's trading right now below their intrinsic value. Use a lot of fundamental analysis. You're trying to look for like low PE stocks as one example. So those are your two types of stocks that you can buy. With fixed income products, I'll just go over this quickly. You have your investment grade, which are BBB rated or above, or you have your high yield or junk grade bonds, which are BB or below for credit rating. So the risk return on the two is obviously equity has a higher risk and therefore a higher return, and bonds have lower risk and lower return. But remember, both can become worthless. If a company goes bankrupt, their equity price is going to be pretty much worthless, and they might default on other bonds, which would make those worthless as well. And just to give you a quick overview of what happens if a company goes bankrupt, well, the bondholders get, the company is broken up, it's liquidated, they get cash. Bondholders have the first rights to that cash. So that's why they're kind of less risky. They're also less risky because their price doesn't fluctuate as much as equity does. But then after the bondholders are all paid, if they're all paid, then the preferred stockholders would get paid second. And if there's anything left over by that point, then it goes to the common stockholders, paid third and last. So that's also why it plays into some of the risk return there. So the two schools of equity valuation. So you've heard of both of these, I'm sure. The first one is fundamental analysis, and that's where your stock price is determined on the financial statements and judging how the company's performance has been in the past and where you think it's going to be going forward. So you look over the balance sheets, the income statement, the cash flow statement, all that good stuff. You can do ratio analysis, you can do stock pricing models, just to see where you think the value of the company is, and if you think the company's overvalued, you don't buy, and if you think they're undervalued, you buy. The other field is technical analysis, and that pretty much, when you come down to the root of it, technical analysis pretty much is that stock price is determined by the supply and demand for a share of the company you're analyzing or looking at. So if there's a high supply and a low demand for a company, that's not good. Yet if there's a low supply and high demand, you want to be a holder of that company. So I just want to do a first things first before I get more in detailed on fundamental and technical analysis. Stock pricing is a forward-looking game. I know when a lot of people first get into this stuff, they look at what the company has done historically, and they try and say, well, if they did well over the last 5 years, they must be a good company. Well, it's not really how they've done over the last 5 years. It's how they're going to be doing over the next 5 years. So you can use the historical stuff to judge what they're going to do over the next 5 years, but you really have to remember that it is a forward-looking game. Also remember that the market is a smart entity. I think it was Benjamin Graham who used to call the market Mr. Market, and he used to try and beat Mr. Market all the time. He looked at it almost as it's one entity. He put a name to it, Mr. Market, and he knew it was a smart entity because there's a lot of smart people managing a lot of money. So you're really not going to get a lot of opportunity to pull the wool over someone's eyes or something. So that's what goes into my third bullet point here, and that's if it's something looks good to be true, triple check. Now usually if something looks good to be true, it is too good to be true, is kind of what the saying goes. But there are times where you'll see, kind of my fourth point there, winning on market emotions is one of the only real ways to beat the market. People do get emotional in the market. They overbuy on good news and they oversell on bad news. So if you see someone oversell on bad news, but you think the news wasn't that bad, well, it looks too good. It looks good to be too good to be true. Just triple check your stuff. Are you sure it's not as bad as you think? And if the answer is yes, then go for it. So just some things to think of first before we dive into the other stuff here. So we're going to first start off with fundamental analysis. And as I said earlier, it's about analyzing the financial statements, the income statement, balance sheet, statement of cash flows. You project future growth rates based on historical performance of what they've done in the past. It's good. Using historical performance is a good indicator of how well management has performed in the past to kind of gauge how well management's going to do going forward. But you also got to remember, the last 5 years, the economic situation is going to be a lot different than probably the next 5 years. At least right now in 2010, we're hopeful of that. So you got to kind of take into account what the economic and industry projections are going forward as well, because they could have had a great last 5 years, but if the industry projections, and the industry's expected to shrink or whatever, or there's new products coming in that are going to, substitute for what the company's currently selling, whatever it is, you got to kind of keep an eye out for that. As I also said, a real popular thing to use is ratio analysis. Why it's popular is because it's really quick and easy to use, and it's somewhat quite effective. It's something that when you first get into the market, you use a lot of it because it is easy to kind of gauge. You take the price, like the first one, the PE ratio is probably the most famous ratio out there. Price divided by earnings. And earnings is a huge factor of what you buy in a company. You are buying those earnings and those earnings projections going forward. So if you want to learn more about fundamental analysis, I put some books down there at the bottom: The Intelligent Investor, One Up on Wall Street, Mad Money, and Financial Statement Analysis. They're all pretty good. They might tell you different ways of how the author or who they're talking about invests, but they'll give you a good understanding of the different terms and stuff like that, a lot more than I can do in my 10-slide PowerPoint presentation here. So next thing we're going to talk about is technical analysis, where, as I said earlier, price is based on the supply and demand for stock. You analyze stock charts. Chart analysis is very heavy in technical analysis to kind of look for indicators, leading and lagging, and oscillators. So it is considered taboo amongst many finance academics. I know many of my finance professors, they didn't even bring it up, because it is oftentimes a trend thing. A technical indicator or whatever might work for 5 years, and then after that it won't work. So it's not something that can be used indefinite. So you got to be real careful with technical analysis. If you are new coming into this, you can kind of get your feet wet in technical analysis, but I really recommend that you learn the fundamental analysis first and then go into technical analysis. As I have there in my last bullet, it is used mostly by traders and not really by investors. And the difference between traders and investors is traders are buying and selling stocks, and they have a high turnover ratio in their portfolios. Investors are more the buy and hold, not buy and hold forever, but hold it for a longer period of time. So that's the difference between a trader and an investor. So you're probably new to this. You're probably going to be doing more of the investing. So you're probably not going to be doing too much technical analysis, because technical analysis really gears around trends in the current market right now, current situations that could change in just a month. So you probably have a little bit longer of a time horizon for your investments than that. So if you do want to learn more about technical analysis, some books for that are Trading for a Living, Technical Analysis of Stock Trends, and Reminiscence of a Stock Operator. All good books, all kind of get you a more understanding of the technical analysis field. So resources to use: you're new, I recommend you go to Investopedia and you use their stock simulator. Or if you don't want to do that, you can just do a paper account. Don't put the money in yet. Kind of get used to this, the market swings, and get used to this field first before you put your money in. You can use Yahoo Finance, Google Finance, Morningstar, MarketWatch, and there are dozens of good sites for stock data. If you want to get some good stock charts, I like the freestockcharts.com. You will have to download Microsoft Silverlight, I believe, but it's a free download to use there. I like that. If you want to look kind of dabble in technical analysis, it's a good site for that as well. So finally, last slide, where to go now. Use the resources I've provided, the books, the sites, all that. Investopedia also has a huge dictionary of all the terms out there, so you can really learn a lot on that website too. As I said, practice on a paper or in the simulator account first, because it is a whole different game when real money is on the line. And you want to remember, when real money is on the line, you're going to kind of think differently, and you're going to get a little bit more emotional in it. So you want to stick to your game. Don't lose your head or your emotions. And also remember that good companies do not always have a good stock price. Now, you can like a company, you can like what they do, but their stock price could be overbought right now because everyone else likes what they do and all that. So just keep in mind that you got to kind of separate what the company is and what the stock price is, because oftentimes a good company will have a good stock price. You want to invest, but as I said, the market's a forward-looking game, so that stock price is usually already priced in all the good company aspects that the company has going forward. So finally, nobody has ever or will ever master the stock market. I mean, I'm sure Warren Buffett will tell you that he hasn't mastered it yet. I mean, it is a continuous learning experience. You'll be learning from now until the end. I mean, it's going to be learning all the time. What's also nice about it is it's always evolving, so there's always something new to learn. There's new products, new economic variables that get introduced, so you always are going to be learning something. I mean, I'm learning something every day, and I think it's what makes it more interesting too. It's something you can never get bored of. So, I hope this all helped, and I wish you best of luck. If you do have any questions, let me know. Please subscribe to my page and check out some of my other videos. I hope it helps, and good luck. Thank you.